Dollar slides as Trump's tariffs rattle global markets.
Market panic. Trump's trade war shakes the U.S. dollar.
Global investors dump the dollar amid tariff escalation.
Trump's tariffs ignite currency crisis fears worldwide.
Shock 1. Global buyers dumping U.S. bonds. Shock 2. The dollar losing its safe haven status. Shock 3. Inflation roaring back home. They're happening right now. Trump's tariff war has set off a cascade that could rewrite how the world values the U.S. dollar. From Beijing to Berlin, central banks are trimming dollar reserves, shifting into gold, yen, and the yuan. And if this slide continues, it's not just an international problem, it's your paycheck, your mortgage, your future. Because when the dollar falls, every American falls with it. The U.S. dollar has been the world's anchor for 8 decades, the currency of safety, of power, of trust. So when it moves suddenly, every trader, every bank, every government feels the quake. And this month, it moved. After Trump announced a new round of tariffs, 25% on Chinese electronics and machinery, the U.S. dollar index dipped more than 1% in a single week. That may sound small, but in currency markets, it's a seismic shift. It was the biggest drop since the start of his second term. Why? Because markets hate uncertainty, and tariffs are uncertainty in motion. Shock 1. Global buyers dumping U.S. debt. Foreign governments hold roughly $7 trillion in U.S. treasuries. Those bonds are the foundation of the dollar's strength. But the moment tariffs threaten growth, yields rise and bondholders begin to sell.
Japan and China, the two largest holders, have cut their positions for 3 months straight. Even U.S. allies like South Korea and Germany are shaving exposure. The World Bank estimates that for every 1% increase in trade barriers, foreign demand for U.S. treasuries drops by roughly $90 billion. That's not an abstract metric. It means less capital flowing into America and a weaker dollar to pay for imports, energy, and wages. When foreign buyers sell treasuries, 2 things happen instantly. First, bond prices fall and yields spike. Second, the cost of servicing America's national debt soars. America already spends more than $1 trillion a year on interest alone. A half-point rise in average yields adds another $120 billion to that bill. That's money that doesn't go to infrastructure, education, or defense. It just disappears into interest payments. Meanwhile, a rising yield environment forces the Federal Reserve into a corner. Cut rates to protect growth and risk a currency slide, or raise rates to defend the dollar and choke the economy. It's a trap with no exit. Tariffs are taxes on trade, but they also act as taxes on trust. Every new duty Trump announces on steel, autos, chips sends a message to the world. America is less open, less predictable, less safe for capital. That's why the dollar fell even as U.S. interest rates remained high, a rare disconnect that signals global investors are worried about policy risk, not just profits.
By late September, the IMF reported a noticeable shift in foreign exchange reserves, dollar holdings down to 58% of the global total, the lowest in 20 years. The difference flowed into gold, the euro, and the Chinese yuan. That's the quiet vote of no confidence that precedes a storm. On Wall Street, currency futures showed a sharp rise in hedging against dollar declines. Institutional funds shifted billions into commodities and emerging markets. Even major U.S. corporations, Apple, Caterpillar, and GM, warned investors that currency swings could erase profits. The message was clear: trade policy is becoming monetary policy by accident. When you weaponize tariffs, you risk collateral damage to your own currency. Shock 2. The dollar loses its shield. For decades, the dollar's real power was psychological. In every crisis, war, pandemic, recession, money fled to the greenback. It was the ultimate safe haven. But what happens when the crisis comes from the United States itself? As Trump's tariffs spread from China to Europe and Canada, the rest of the world stopped seeing America as a stabilizer. Instead, it saw a source of volatility. Central banks in India, Singapore, and Switzerland cut their dollar exposure 2 to 3% each. That's hundreds of billions quietly diverted away from the U.S. system. When confidence drops, so does demand for dollar-denominated assets. And when demand drops, the currency weakens no matter what the Fed does. It's like a strong body that's lost its immune system.
This isn't the first time tariffs have rattled the dollar. In 1985, the Reagan administration faced a similar problem after years of trade friction with Japan. Back then, major nations signed the Plaza Accord to deliberately weaken the dollar and restore balance. But today, no such coordination exists. The world is fractured and every country is acting alone. That makes the slide harder to control. Inside the Federal Reserve, officials see the danger. Higher tariffs mean higher prices for imports, and inflation above the Fed's 2% target. But raising rates to fight inflation would strengthen the dollar too quickly, hurting exports. Cutting rates would weaken it further and fuel panic. Either way, the Fed is boxed in. Every decision feeds the next shock. You might not track foreign exchange charts, but you feel their impact every day. A weaker dollar makes imports from phones to fuel to food more expensive. If the greenback drops 5%, average household costs rise roughly $1,200 a year. Add tariff inflation on top, and you get the perfect storm for the middle class. Higher prices, higher interest rates, and stagnant wages. The psychological effect is worse. As people see the dollar slide, they lose faith in savings. They rush to buy hard assets, real estate, gold, crypto. That pushes speculative bubbles higher while the real economy cools. It's the illusion of wealth before the collapse of confidence.
Shock 3. Inflation comes home. By October, consumer prices were rising at a 4.3% annual rate, the highest since 2022. Energy led the surge, followed by imported goods like electronics and vehicles. What's different this time is that the inflation isn't driven by demand, it's imported through the exchange rate. Economists call it pass-through inflation. When the dollar drops, everything priced in dollars from oil to wheat gets more expensive globally. So while the White House celebrates tariff revenues, consumers quietly pay the hidden tax through rising prices. That's the moment when politics meets reality and the currency pays the bill. No one in Washington wants to say it out loud, but the US is flirting with what markets call confidence erosion. When foreign investors begin to see policy as unpredictable, they demand a risk premium to hold your money. That premium is visible now. The dollar's volatility index is up 40% year to date. It's the kind of number that precedes a stampede. And that is where part 2 begins, with the world's faith in the US currency starting to fracture. Because when the dollar wobbles, the entire financial architecture built on it starts to crack. In the next segment, we follow the domino trail from foreign exchange desks to American families to see just how fast Trump's tariff shock could turn into a full-blown monetary crisis. When the world stops trusting America's money, everything America buys, builds, or borrows gets more expensive. And that loss of faith is spreading faster than anyone predicted.
The first signs appeared in foreign exchange desks in London and Singapore. Traders began shortening the dollar, betting it would keep falling. By mid-October, speculative short positions on the US dollar index hit a 4-year high. That's Wall Street's way of saying, we think Washington lost control. At the same time, global central banks cut their dollar holdings by another $150 billion. Gold purchases surged 12% year on year. When gold rises while the dollar falls, it means investors are hedging against policy, not inflation. They're protecting themselves from America, not within it. Shock 4. Capital flight from US markets. Capital always chases safety. But if tariffs make America look risky, money runs elsewhere. In the last quarter, foreign inflows into US equities dropped nearly 20%. At the same time, emerging market funds saw record gains. Even Europe, battered by its own stagnation, suddenly looked calmer than Washington. For the dollar, this means pressure from two sides, less investment coming in and more capital leaving. Each dollar sold abroad weakens the currency further. Each weakened day raises import costs. It's a feedback loop that turns policy into panic. Inside the Federal Reserve, alarms are flashing. Officials track capital outflows and bond yield spreads like doctors monitoring a failing heartbeat. If they hike rates to lure investors back, they risk recession. If they cut rates to ease borrowing costs, they risk a deeper dollar slide. Either choice feeds the narrative that the US has lost monetary control.
A leaked memo from regional Fed economists warned that persistent tariff uncertainty could erode the credibility of the dollar as the world's reserve. That's diplomatic language for collapse of trust. Shock 5. The bond market revolt. The US Treasury market, the backbone of global finance, runs on confidence. If buyers demand higher yields, the government pays more to borrow. By late October 2025, 10-year yields climbed to 4.9%, the highest since 2007. That single jump adds hundreds of billions to America's debt cost. And here's the real danger. As yields climb, existing bond values drop. Banks, pension funds, and insurers holding treasuries see losses on paper. That tightens credit across the system. Less lending, higher mortgage rates, shrinking liquidity. It's the invisible tax of a weakening currency. For ordinary Americans, the chain reaction lands right in the wallet. Gasoline. With the dollar weaker, oil priced in foreign currency costs 10 to 15% more. That means 30 to 40 cents extra per gallon. Groceries. Food inflation from imported fertilizers and packaging adds another 4% to the average bill. Loans. As yields rise, mortgage and credit card rates climb. A typical $300,000 home loan costs $250 more per month than last year. Jobs. Manufacturers relying on foreign components face higher input costs, forcing layoffs. This isn't a theoretical downturn. It's a transfer of pain from Wall Street to Main Street.
Shock 6, the global repricing of power. When foreign nations lose faith in the US dollar, they start building alternatives. In 2025 alone, China and Russia settled 30% of their trade in non-dollar currencies. Brazil and India launched regional payment systems. Even US allies like France and Saudi Arabia signed bilateral deals in euros and yuan. Each agreement cuts a tiny thread from the web that once held the dollar dominant. Alone, they're harmless. Together, they signal something historic, the start of a multipolar currency world, and it's happening during a US trade war that was supposed to reassert American strength. That's the ultimate contradiction. The world has seen this movie before. In the late 1960s, the US ran huge deficits to fund Vietnam and the Great Society. Confidence cracked. In 1971, President Nixon suspended the gold standard, ending the Bretton Woods era. The dollar plunged 30% within 2 years. Oil prices tripled. Inflation spiraled. That was America's last major monetary crisis. Now, half a century later, another president is testing the system with tariffs and deficits. The similarities are too loud to ignore. Markets don't wait for official crises, they anticipate them. Once traders believe a currency is unstable, they act, and their actions make it unstable. That's why the dollar volatility index jumped nearly 50% since August. Every hedge, every short position, every move into gold amplifies the slide.
As the dollar weakens, politics tighten. Trump defends tariffs as patriotic economic warfare. Democrats call them financial arson. Congress hears testimony from businesses warning of mass layoffs. And meanwhile, Americans watch their cost of living rise while savings erode. The White House blames the Fed blames external shocks, markets blame everyone. Blame is the currency of panic, and right now it's trading at record highs. Money is not just paper and numbers, it's belief. If Americans stop believing their currency is safe, they start behaving like it's not, pulling cash, hoarding goods, investing abroad. The dollar then weakens further, confirming their fears. That's how a superpower's currency turns from symbol to suspect. And it's why tariffs, though aimed at foreign competitors, become a weapon turned inward. Each new round meant to protect American industry chips away at the very foundation of its money. Possible exit paths: ceasefire on tariffs. Negotiating limited deals with China and the EU could stabilize markets within months. Joint central bank action. Coordinated currency support between the Fed and the ECB might halt the slide temporarily. Fiscal discipline. Cutting deficits and reassuring creditors would restore confidence, but it requires political pain. None of these are easy, all are urgent, because once a currency crisis crosses a psychological threshold, it rarely reverses quickly.
If the US dollar continues to fall, emerging market currencies linked to it, the peso, the real, the baht, could swing wildly. That means imported inflation for dozens of countries. In Europe, a stronger euro hurts exports just as recession looms. In Asia, China's yuan strengthens by default, giving Beijing more leverage in trade negotiations. A weaker dollar doesn't weaken America alone, it reshapes the entire global balance. Currencies don't crash like buildings, they erode like mountains, quietly, grain by grain, until the peak is gone. Trump's tariffs were meant to make America stronger. Instead, they've shaken the foundation of the very thing that defines its strength, the dollar itself. When a nation uses its economy as a weapon, the first casualty is trust, the second is value, and the third, if we're not careful, is the future it was trying to protect. The world is watching America's currency slide inch by inch. The question is no longer if it breaks, it's who falls with it.